Oh, Canada. Well, despite uncertainty for the economy and lingering trade questions, the Canadian stock market has been on a roll. This morning, we've seen another all-time high for the TSX, surpassing 28,000 for the first time. That puts the advance since the April lows at about 25%. For more on the move, let's check in with Martin Cobb. He's Senior Vice President of Equities at Lorne Steinberg Wealth Management. Martin, nice to have you back with us. What do you make of this big move we've seen for the Canadian stock market?
Yeah, good morning, John. Yeah, what a difference, a year makes, or a year or so makes. The Canadian stock market was such a laggard in the first half of 2024 and has been one of the best performing stock markets since then. And if you drill down, there's been a couple of factors. Obviously, gold stocks maybe contributed close to half the returns, year to date. And then Shopify and its fellow software brethren have certainly kicked in terms of producing good returns. But it is broadening out to some extent. We own a number of the banks up here and several other sectors that are starting to perk up to some extent. So there is some concentration in terms of the returns, but a little bit broad, a little bit greater breadth is always a good thing. Yeah,
I guess let's stay on that gold theme for just a second. The material sector is now looking at something like a 40% advance so far this year. And as much as people say, a lot of that heavy lifting came in the early part of the year, even over the last 3 months, materials still hanging in there, outperforming the TSX itself. And I was saying, everybody on Wall Street is now talking about the likelihood of Fed rate cuts, but gold itself is still hanging in there. And I wonder if we can have, two things being true, a willingness for people to be risk on, and also almost an unease with whether it's geopolitical concerns or where the economy might be headed.
Yeah, it is certainly a little bit unusual. You hit the nail on the head there. We have markets at all-time highs and the gold price at all-time highs, and those tend not to go hand in hand. Any student of history will tell you that. There just seems to be this ability for gold to, it's a nice insurance policy. There are two camps really in gold, those who love the thing and think it's the best thing since sliced bread, and those who see it, the Warren Buffetts of this world, see it as an asset that gives you nothing in terms of return or yield. I'm probably somewhere between the two. I like to have a little bit of gold. It does provide great portfolio insurance as a tail risk. And over the long term, has a great correlation with real interest rates, lower real interest rates. So there's a lot of factors pulling it both up and down, but it seems to be satisfying some investors, if not all.
Now, I think of you guys as putting value on a high pedestal, looking for, opportunity that is measured through where a stock is trading and where it could potentially trade. In this kind of environment, how are you approaching your investments?
Yeah, it's getting harder and harder. You just look at headline indices and just headline valuations, particularly south of the border in the US, and you kind of scratch your head. And valuations matter not a jot in the short term. The stock market can continue to ascend, and individual stocks can continue to get pricier, even when you think they've gone beyond any kind of sensible, intrinsic valuation measure. So I'm becoming a bit more contrarian. It kind of waxes and wanes to some extent. So looking beyond, the AI party, looking beyond what is driving investors into certain types of stocks, what might be left behind. So there's always something out there, whether it be in Canada or globally. Elsewhere, there's always pockets of pessimism, as John Templeton would like to say.
Okay, well, let's go through a few examples. Why don't we start with Canada? We've been talking about technology getting a lot of love this year. Openex is a company that just announced some changes at the top, a management shuffle. Stock has struggled versus some of the other technology companies out there. You're watching it right now, though, are you?
Yes, I love to own the best businesses in the world. Openex is not one of them. Let's be clear. It really struggles for organic growth. But over the long term, more important than how you operate the business for management is capital allocation. There's a book just behind me here, William Thorndike, The Outsiders, which should be required reading for every CEO, every CFO. This is a company that today is struggling for growth, and if you read the analyst reports, they're all saying, can they just get back to positive organic growth? that doesn't really matter in my view. They can eat themselves simply because of their free cash flow. They generate roughly $1 billion of free cash flow every year. Their market cap is 7 or 8 billion. So that's something like a 14% free cash flow yield, meaning they could buy back their stock in about 7 or 8 years. Forget trying to drive the growth. And I'm hoping the change in management will deliver this. Maybe I should send them the book. It might be a good idea. Just eat yourself and don't worry about trying to get organic growth. And I mean, CEOs can't help themselves. They like to run bigger businesses, typically comes with a bigger pay package. But in terms of delivering for shareholders, when you're trading on 7 times earnings, a 14% free cash flow yield, and you have that free cash flow to deploy, you can make yourself and your shareholders very wealthy if you just buy back your own stock.
All right. Now, there are some trends around the world. I mean, we've obviously talked endlessly about the AI story, about the big infrastructure build out, but something that has also been a growing theme is aging populations. And I noticed that you've had your eye on Smith and Nephew as well. So this would be more sort of a global play. Can you just remind us what their business is all about and why it is getting your attention right now?
Yeah, Smith & Nephew is possibly the oldest stock that we own. It was founded in 1856 by Mr. Smith, who was then joined by his nephew, sort of 30 years later, as a chemist shop in the UK. They are a provider of hips and knee implants, various advanced wound care products. Don't Google diabetic foot ulcers. Please don't look at images of that. They have sports treatments, etc. They compete with Stryker, Zimmer Biomet, the Depay division of J&J. So they are serving, aging, heavier populations. Ozempic and co might, slow that down to some extent. We're all getting a bit older, particularly in the West. We're still getting a bit heavier, particularly in the West, although the East is catching up to some extent. So it's long-term medical devices for an aging demographic and a heavier demographic. That's what I like about the business and the industry, and they're a market leader in every area in which they operate.
All right. Great to get your perspective as always, Martin. Thanks very much. Martin Cobb joining us, Senior Vice President of Equities at Lorne Steinberg Wealth Management.